How can an investor ever truly know what a company is worth? Not what the market says it's worth, not the flashing number on a screen, but its real worth. Every investor, at one point or another, faces this same haunting question. It's the question that echoes through every market bubble and every crash, every surge of optimism and every wave of fear. How can we tell the difference between a sound investment and a dangerous illusion? Benjamin Graham asked this question not once, but for an entire lifetime. And out of that lifelong search came something extraordinary, a quiet, logical, deeply human framework that has stood the test of nearly a century. He called it his 10-point valuation test. It wasn't a formula for quick riches. It wasn't designed to predict the next big thing. Instead, it was a safeguard, a shield against human error. Because Graham understood something most investors never do, that the greatest risk doesn't come from the market, it comes from ourselves, from our hopes, our impatience, and our willingness to believe what we want to be true. So he built a test, a checklist, 10 simple, rational questions that could separate investment from speculation, reality from illusion, safety from danger. And yet, nearly a century later, very few investors even know it exists. Those who do, the few who have studied it, often discover that Graham's 10-point test still works, even in the age of algorithms and AI. It works because it wasn't about numbers alone. It was about judgment, about learning to see through the crowd's excitement and back to the bedrock of value. This episode is about that test and the timeless wisdom behind it. We'll uncover why Graham built it, what each principle means, and how this century-old framework can still help you judge a company's financial strength with the calm, steady reasoning of the world's greatest value investors. Because while markets change, the human mind does not. And the greatest advantage you can have is not faster information, but clearer thinking. To understand why Benjamin Graham built his 10-point valuation test, we need to step back to a time when the very idea of investing meant something different. The year was 1929. The market was booming. Fortunes were being made overnight, and Benjamin Graham, then a young, brilliant analyst on Wall Street, was among those who seemed destined for endless success. He had built a sterling reputation as one of the sharpest financial minds of his era. He understood balance sheets, studied earnings reports, and believed deeply in rational analysis. But even his careful reasoning could not protect him from what came next. When the great crash struck, Graham lost nearly 70% of his wealth. Companies he thought were sound evaporated in weeks. The rules of the game, if there had ever been any, no longer seemed to apply. And in that moment of chaos, he began asking himself the questions that would define the rest of his life. How could intelligent people make such foolish decisions? Why did markets behave like crowds, swinging from euphoria to panic? And most importantly, how could an investor ever truly know if a company was safe to own? Graham didn't respond with emotion or despair. He did something far more powerful. He began to study the madness. For years, he examined hundreds of financial statements, tracing the patterns of failure and survival through the wreckage of the Depression. He compared companies that endured with those that perished. He analyzed the difference between a firm that bent under pressure and one that quietly survived. And from that monumental study came an insight that changed the course of financial thought. That sound investing could not depend on prediction, it had to depend on protection. That protection, Graham realized, could only come from rigorous analysis. a set of logical tests that could reveal whether a company was built on solid ground. And so, piece by piece, through experience, loss, and relentless observation, he began to build his framework, a checklist that would later evolve into his 10-point valuation test. Each point represented a safeguard, each question a barrier between speculation and sound investment. Together, they formed a system that could outlast even the wildest extremes of human behavior. Graham didn't just want to make money. He wanted to create order out of chaos. And for those willing to learn his method, he offered something much rarer than a hot tip or a clever trade. He offered peace of mind, the ability to invest not with emotion, but with understanding. Benjamin Graham's 10-point valuation test wasn't a secret formula for instant profits. It wasn't designed to beat the market, at least not in the way people usually think. It was designed to protect the investor, to separate the solid from the fragile, the real from the illusion. You see, in Graham's view, the market price of a stock told you what others thought it was worth. But the book value, the company's assets, liabilities, and tangible resources, told you what it was actually made of. And between those two figures, price and value, lay the emotional battlefield where investors so often lose their way. That's where Graham's 10-point test came in. It wasn't just a set of calculations, it was a discipline, a system for seeing through illusion and emotion. Each point tested a different layer of safety, stability, or value. Was the company financially strong? Was it profitable through good times and bad? Did its earnings grow consistently over the years? Were its dividends reliable and reasonable? And perhaps most crucially, was its market price low enough in relation to its value to provide a margin of safety? If a company could pass enough of these tests, Graham believed it was worthy of consideration by the defensive investor, the kind who seeks preservation first and profits second. To Graham, investing wasn't about predicting the future. It was about measuring the present accurately enough that the future mattered less. He often said, "The essence of investment management is the management of risks, not the management of returns." The 10-point test, then, was not a way to outsmart the market. It was a way to protect yourself from it. Each question forced the investor to confront reality, to look at numbers, not narratives. And in doing so, it replaced emotion with evidence. A company might be exciting, innovative, and full of potential. But if it failed Graham's tests, if it was over-leveraged, overvalued, or erratic in earnings, it was not an investment. It was speculation. And for Graham, speculation had no place in a plan meant to last a lifetime. Nearly a century later, his 10-point test still stands as one of the most rational frameworks ever devised. But what exactly were these 10 points? And how did Graham use them to separate opportunity from illusion? That's what we'll explore next. Benjamin Graham's 10-point valuation test first appeared in his later writings, where he sought to simplify the vast complexity of security analysis into something both practical and timeless, something the everyday investor could actually apply. It was his attempt to translate the art of intelligent investing into measurable logic. Let's go through the essence of these 10 tests, not as rigid rules, but as guiding questions, the way Graham intended them to be used.
1. Adequate size of the enterprise. Graham believed size mattered, not in glamour, but in resilience. Large or mid-sized companies were better able to withstand economic storms. He warned that small, thinly capitalized firms often lacked the strength to survive a severe market contraction. As he put it, a strong company is like a fortress. It endures not by luck, but by strength of structure. 2. Strong financial condition. The next test examined the balance sheet. For industrial companies, Graham wanted current assets to be at least twice current liabilities, a 2-to-1 current ratio. For utilities, long-term debt shouldn't exceed the value of equity. To him, debt was like fire, useful in moderation but destructive when uncontrolled. He once wrote, "The chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions." 3. Earnings stability. A good business, in Graham's mind, was one that could stay profitable through all seasons. He required positive earnings for each of the past 10 years. No company that swung from profit to loss repeatedly could be considered reliable. This simple filter eliminated the vast majority of speculative favorites, the ones built more on hope than durability. 4. Dividend record. Graham saw dividends as a sign of real-world discipline. A company that paid regular dividends for at least 20 consecutive years proved both profitability and respect for shareholders. It showed a commitment to rewarding the investor, not just enriching management. As he famously noted, the true investor rarely gets poor from receiving dividends. 5. Earnings growth. He wanted earnings per share to grow at least 33% over the previous decade, modest by today's standards, but realistic and sustainable. Graham didn't demand explosive growth. He wanted dependable growth. For him, consistency mattered more than excitement. 6. Moderate P/E ratio. Here, Graham set a limit. The P/E ratio should not exceed 15 times average earnings over the past 3 years. This was his way of ensuring investors didn't overpay for popularity. He observed that the greater the excitement around a stock, the greater the chance that reason had already left the room. 7. Moderate P/B ratio. A company's price should not exceed 1.5 times its book value. But he allowed flexibility. If a stock had a low P/E, it could justify a slightly higher P/B, provided the product of the two didn't exceed 22.5. This simple equation, P/E times P/B is less than or equal to 22.5, became one of the most enduring mathematical reflections of his philosophy. 8. Reasonable dividend yield. While Graham didn't demand high yields, he preferred companies that offered a fair return on capital. If a stock paid nothing, it left the investor entirely at the mercy of market fluctuations. To him, an investment that depends solely on the market's kindness is speculation in disguise. 9. Earnings to price yield versus bond yield. The stock's earnings yield, that is, E to P, should be at least equal to the yield on high-grade corporate bonds. Why take on the uncertainty of owning a business if it doesn't even compensate you for the risk compared to lending money? It was Graham's way of comparing reality to opportunity. 10. Margin of safety in valuation. The final and most important test. The stock's price must offer a margin of safety, a cushion between what you pay and what the business is worth. Even if every other test passed, Graham wouldn't buy unless this final condition was met. Because, as he often reminded his students, the margin of safety is the central concept of investment.
Graham never claimed perfection for this checklist. He called it a practical approximation, a way to bring sanity and structure to an emotional endeavor. No company would score perfectly on all 10 points, but the investor who demanded most of them would dramatically reduce their exposure to permanent loss. That was the goal. Not to chase what was popular, but to endure, compound, and prosper quietly while others played a different, noisier game. But how does this framework hold up in today's market, an age of tech stocks, zero dividends, and financial engineering?
What would Graham say about companies like Apple, Tesla, or Amazon? Let's explore that next. Nearly a century after Benjamin Graham formulated his 10-point valuation test, the market looks nothing like it did in his day. Back then, railroads, industrial manufacturers, and utilities dominated the financial landscape. Book value was tangible, made up of factories, machinery, inventory, and cash. Earnings were rooted in physical production. Dividends were expected, not optional. Today, the market is a universe of software platforms, algorithms, intangible assets, and global liquidity. Companies can be worth billions without owning much of anything tangible. The balance sheet has become a mirror of abstractions: goodwill, brand value, intellectual property. So the natural question arises: can Graham's checklist still work in an age where value hides behind code, data, and design? At first glance, it might seem outdated, even impossible. How do you apply a book value test to a software firm whose main assets are engineers and ideas? How do you assess a dividend record when even the most admired companies reinvest everything they earn? And yet, if we look deeper, we realize that Graham's framework was never about the numbers themselves. It was about the discipline behind those numbers. The numbers were symbols, markers of prudence, strength, and consistency. What mattered wasn't the exact ratio, but the mindset that produced it. Take earning stability, for instance. Graham required 10 years of positive results. Today, that still applies, though we might translate it to consistent cash flows, not just accounting profits. The principle remains. A business that endures across cycles is inherently more reliable than one that thrives only in euphoria. Or consider the P/E ratio. In Graham's time, 15 was a guardrail, a warning against excitement overtaking reason. In a world where interest rates fell near zero, the market pushed valuations higher, arguing that this time is different. But was it? When rates began to rise again, we saw how fragile those new paradigms truly were. Graham's quiet wisdom echoed through the noise. The more things change, the more they remain the same in principle. Even the book value test, often dismissed today, still carries meaning, though it requires reinterpretation. Instead of focusing purely on tangible assets, the modern investor can examine replacement value, cash-generating power, or owner's equity adjusted for reality. In essence, the question remains: is the price I'm paying justified by what this business can truly deliver over time? That is still Graham's question: timeless, adaptable, universal. Now let's consider some modern parallels. If Graham were alive today, he might not reject technology stocks outright. He would simply demand proof of enduring value, consistent profitability, disciplined capital allocation, and a margin of safety. Take Apple, for example. It passes several of Graham's filters: consistent earnings, dividend payments, strong financial condition, and modest valuation relative to cash flow. Contrast that with Tesla in its earlier years: volatile earnings, heavy reliance on optimism, and minimal margin of safety. Graham wouldn't have called it an investment. He would have called it a speculation, albeit an interesting one.
What about companies with negative earnings but immense potential? Startups, disruptors, or innovators? Graham's view was clear. That realm belongs to the enterprising investor, not the defensive one. The defensive investor seeks protection first. The enterprising investor accepts uncertainty, but only with clear logic and a small allocation of capital.
He never said speculation was evil. He simply said it must be labeled honestly. And then there's the concept of the margin of safety, Graham's final and greatest principle. In a world driven by momentum, speed, and prediction, this idea has never been more radical. Because the margin of safety is not about timing the market, it's about surviving it. It is the humble admission that the future is uncertain, that we will sometimes be wrong, and that our best defense is not confidence, but prudence. So yes, the specifics of Graham's 10-point test may need reinterpretation, but the spirit behind it remains as relevant as ever. To measure not just price, but strength. Not just potential, but proof. Not just excitement, but endurance. That is what separates speculation from investment in 1934, in 1950, and in 2025. Next, we'll slow down and reflect, not just on the rules, but on the wisdom behind them. Why did Graham value restraint more than prediction? Why did he believe that the best investors think more like historians than prophets? Let's explore the philosophy that made these 10 points more than a checklist, a way of seeing the world. Benjamin Graham once wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." And behind that one line lies the soul of his entire philosophy. Because Graham understood that valuation, ratios, and formulas were only the surface of investing. The deeper struggle, the true battlefield, was psychological. When he built his 10-point valuation test, it wasn't just to measure companies, it was to protect investors from themselves. Each rule acted as a guardrail, a quiet defense against greed, impatience, and overconfidence. A high current ratio demanded discipline before excitement. A limit on the P/E ratio curbed the urge to chase fashion. A record of steady dividends reminded investors that consistency matters more than charisma. To Graham, these weren't mechanical filters. They were moral instruments, tools of character as much as of calculation. He often compared investing to a moral discipline, almost like philosophy itself. He wrote, "The essence of investment management is the management of risks, not the management of returns." That single distinction reveals everything about his worldview. Where most investors chased profit, Graham sought permanence. Where others tried to predict, he preferred to prepare. He didn't ask, "How much can I make?" He asked, "How much can I lose and still recover?" At its core, Graham's 10-point test is an expression of humility. It assumes that we cannot see the future, that no one, no analyst, no CEO, no economist is wise enough to predict the next 5 years with precision. And so, we build defenses. We choose businesses that can stand on their own strength. We pay prices that leave room for error. We invest only when the odds are meaningfully in our favor. That humility, the willingness to be cautious in a world addicted to certainty, is the mark of wisdom. Graham lived through the Great Depression. He watched fortunes vanish overnight. He watched banks close, markets freeze, and the faith of an entire generation shatter. And through it all, he emerged not cynical, but wiser. He realized that every cycle, every boom and bust, was born from the same pattern, the collective forgetting of prudence.
People always believe the new era will be different, that technology, innovation, or monetary policy has rewritten the rules. And yet, beneath the glitter of every age, the same human instincts persist. Fear, greed, imitation, pride. That's why Graham's rules feel almost stoic. They are not designed to help you win more, but to help you lose less. They teach restraint, balance, and emotional endurance, the virtues of a rational investor. It's easy to get swept up in optimism. It's harder to pause and ask, what could go wrong? But Graham knew, true investors must learn to think in probabilities, not predictions. He reminded us, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. This is the quiet defiance of the value investor, the courage to think independently, to act without applause, to prefer soundness over excitement. The 10-point test, then, is not merely a formula for choosing stocks. It's a framework for choosing your temperament. When you apply these rules, you are not just filtering companies, you are filtering your impulses, forcing yourself to slow down, to check your assumptions, to question your confidence. And in doing so, you gradually become what Graham called the intelligent investor. Not one who knows everything, but one who knows himself. Nearly a century later, the same mindset remains the rarest edge in investing. Patience is still misunderstood as passivity. Discipline is still confused with pessimism. And humility, the most essential of virtues, still feels out of place in markets that reward noise. But the truth is unchanging. The investors who endure are not the ones who predict best. They are the ones who prepare best. And so, when we study Graham's test, we study more than numbers. We study a philosophy of rational living in an irrational world. A mindset that values clarity over comfort, independence over imitation, and truth over excitement. In the final segment, we'll bring this all together into simple, actionable lessons you can apply today. Because wisdom, to Graham, was never meant to stay on paper. It was meant to guide how we act, decide, and invest every single day. So, what can we, modern investors, take from Benjamin Graham's 10-point valuation test? How do we apply a framework built in the 1930s to a world of trillion-dollar tech companies, algorithmic trading, and financial headlines that move by the minute? The answer lies not in imitation, but in interpretation. Graham never wanted his readers to memorize formulas. He wanted them to think independently. He gave us a way to reason about value, to separate the measurable from the emotional, the durable from the fragile. Let's distill his wisdom into a few enduring practices. 1. Always begin with financial strength. A company that can withstand adversity is worth far more than one that shines only in prosperity. Look for balance sheets that protect, not just impress. High liquidity, low debt, and a margin of safety in assets remain timeless anchors of resilience. 2. Demand consistent performance. Graham's insistence on a long earnings record was not about perfection, it was about proof. He wanted businesses that demonstrated endurance through cycles. Today, that means watching for cash flow, stable returns on capital, and the discipline to survive downturns. 3. Value must be grounded in reality. Price is a number. Value is a judgment. When a stock trades far above its earnings, its assets, or any logical justification, the investor must pause and ask, what am I really buying? As Graham warned, the investor's worst enemy is likely to be himself.
4. Avoid the trap of prediction. Most investors lose not because they lack intelligence, but because they believe they can forecast the future. Graham urged us to focus instead on what we can measure and control. Strength, stability, and the margin of safety are things we can evaluate today. The future will take care of itself if the foundation is sound. 5.
Embrace the margin of safety as a way of thinking. It's not just a rule for buying undervalued stocks. It's a philosophy of humility. It reminds us to leave room for error, to respect uncertainty, and to build buffers in portfolios, in decisions, and in life. If we take nothing else from Graham's 10-point test, let it be this. The purpose of investing is not to be clever, it is to be wise. Wisdom doesn't shout, it whispers. It asks us to look beneath excitement, to seek substance over story, and to remember that success built on reason is the only success that endures. Graham's teachings are not just about money, they are about character, the kind that remains calm when markets are euphoric and patient when they are panicked. He understood something that few investors ever do, that the stock market is a mirror, reflecting not the truth of businesses, but the temperament of the people who trade them. And the investor who masters himself masters the market. Today, as algorithms chase momentum and headlines reward noise, Graham's voice feels almost revolutionary in its quietness. He asks us to slow down, to think, to examine every opportunity not with excitement, but with equanimity, and to remember that in the long run, value is not a fashion, it is a fact. So perhaps the true secret of Benjamin Graham's 10-point test is not in the numbers at all. It's in what those numbers teach us about discipline, patience, and the courage to think for ourselves. Because investing, at its highest form, is not speculation, it is philosophy in action. And the best investors are not fortune tellers, they are philosophers of probability. As Graham once wrote, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." In other words, you don't have to be extraordinary to succeed. You only have to be reasonable, consistent, and independent. That's the timeless promise of value investing. And that's why nearly a century later, Benjamin Graham's quiet voice still guides those willing to listen, through every market, in every age. If this episode gave you new insight into Graham's way of thinking, I invite you to subscribe to Benjamin Graham Value Insights, where we continue exploring the timeless lessons of the intelligent investor and security analysis. Leave a comment sharing which of Graham's 10 rules you find most relevant today, or how you interpret them in your own investing journey. Together, we can keep the spirit of rational investing alive and pass it forward to a new generation of independent thinkers. Because while markets change, wisdom does not.